and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Bob Yager. He's a senior energy analyst over at Mizuho Americas. And Bob, my question to you is, can it get any worse in the energy space?
Well, actually, for crude oil, it was not a bad week, really. We were at positive territory for the week last week. Against all odds, it was a crazy week. What we have in crude oil, which is very interesting, there's two very large pipelines that came online last week or they're coming on this week. It's a bit gray. But customers are buying crude oil to put into those pipelines. And that kept WTI, the West Texas grade, bid through the week. And it put in a pretty good performance last week.
All right, let's take a look at a number of charts here. Our first one being crude oil. This is we have our year-over-year performance over here.
Yes, it looks pretty good here. I mean, we did not fall apart last week, and we did not really test the lows as opposed to some of the other financial instruments and other financial instruments in energy, for that matter. We're still a good 1,000 basis points away from the December low. So yes, we had some relative strength last year. We're still chopping around towards that 200-day moving average. So crude oil chart, it's trading down towards the low of the range, but we're still staying in the range at least. We have not broken down below the range, which is around the top of the range. I'm sorry, the bottom of the range is about $50.
All right, let's move along to WTI. Is it telling relatively the same story here?
This Brent WTI here, this really reflects the pipeline issues well. You can see that buyers are in the crude oil space, in the WTI space, are just running over the international benchmarks, and they're narrowing the gap between international crude oil and domestic crude oil. That usually runs at like $7 to $10. You can see these levels down here is Brent about $7 to $10 more expensive than WTI. We've been on a ripper lately though because people are filling up these pipelines. They're buying WTI. There's no reason to buy Brent. So nobody's buying Brent. The relationship narrows, and now WTI is only $3, $4 more cheap than Brent.
All right, now moving along to the RBOB crack. Explain to everyone what that is and why, as an energy analyst, you take a look at this.
Yes, this is a big part of the puzzle here. Gasoline is quoted on the exchange in gallons. You have to times that by 42 and you get a gallon of gasoline. Crude oil is quoted in barrels. So gasoline is always going to be at a premium because there's the refining process and all that, but that premium is only at $14 now. That's down, that low is $14.08. At that point, it's not really all worth it that much for refiners to be making gasoline anymore because it's just not, they're not making a lot of money off of it. When they're not making money, they want to slow down the refining process, not use as many barrels of crude oil. Ultimately, that kicks barrels of crude oil out into storage, and that ultimately starts to lean on prices.
All right, now if we take a look at our last chart here, the XLE, the stocks are telling that story because RBOB crack is down. The refiners are just not making money.
It is. Even at WTI, that hits exports and it increases imports, and that adds to storage levels also. But this XLE, this is getting ugly. As I told you, there's 1,000 basis points between where we're trading now and where the low is in December in crude oil and CL1. It's 200 basis points in XLE. So this is not good. And we are getting close. While crude oil held its own last week, and even heating oil did, and even the worst part of the complex as far as the commodity exchange, gasoline, was only down 1.03%, the same that the S&P 500 was down. This was down 3 percentage points plus last week. People are fleeing this space. They're walking away from energy. This was the worst performing S&P 500 sector last week, and it did rally a little bit out of its RSI oversold territory on Friday, and it is above a little bit today, but this is very wobbly ground right here.
Well, it's interesting. Barron's had a piece on this over the weekend, and Phillips 66, interestingly enough, is the only one that is green in the space. I think it's up 12, 13% on the year. What sets them apart versus the other refiners?
Well, they are very good at what they do. Their refinery complex, their situation is relatively modern. Their scale is rather large because they participate in pipeline and some other issues too. They're rather large. And so they have a lot of moving pieces that they're doing well. They have a very professional staff too. It's a top play operation.
Right. Well, it gets to the point, when do these become so cheap on a fundamental basis, and those yields have to be attractive at some point? I mean, obviously they're higher yield for a reason because the stock price is depreciated. When does it start to get interesting here, or do you think there's more pain to come in this space?
Like I said, the best momentum indicator is the RSI, and this was in levels below 30 last week. That's oversold territory, and that's when you start to take notice, and it's oversold at that point. And it did rally its way out of oversold on Friday. That could be the first step towards some people starting to dip their toes into this and getting long this.
Well, then you get seasonality as well this time of year too.
Well, that's not good though. We have to really fight against that because nobody will, in 4 weeks, nobody's going to be driving and nobody's going to be heating their houses. So energy will be on the slide. The refiners will start to scale back. Storage will start to increase, and that's the cycle of life in the energy space.
All right, Bob. As always, thanks so much for catching up with us.
Thank you.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.